Let's bring in former Fed Governor Wayne Angell. We also have former Dallas Fed President Bob McTeer, Brian Westbury of First Trust, Peter Schiff of Euro Pacific Capital, Steve Leisman and Rick Santelli are still with us. I have a feeling they will kibitz as well. Wayne Angell, at the beginning of the day, from what I gathered, you wanted to see the Fed keep their target rate at 1%. Then they took this shock and awe action, which opens up a trading range of 0 to 0.25%, and Katie barred the door for balance sheet expansion. Now I hear you favor the Fed. You've swung from one end to the other in a mere one day. What's up with that, Wayne? Why have you changed your mind?
Well, I've changed my mind because the Fed finally got its act together and is focusing on what it needs to focus on. That is, when you see 30-year debentures of Fannie Mae trading at 3.86%, and you see the prime rate coming down, then you've got the Fed out there focusing and working in a way that is going to help turn around this housing deflation
Wayne
period.
Angell, you used to be the single biggest inflation hawk in the history of America, for heaven's sakes. You were a commodity price rule watcher. Gold, CRB, grains, metals. Now, I know commodities have had a nasty plunge, as has gold. But what we're seeing in the last couple of weeks, in advance of this Fed shock and awe, is a rebound. Commodities are up, gold is up, and the dollar, which have been improving for many, many months in the spring and summer, is now tanking. It took Rick Santelli's breath away after the Fed announcement to see how much the euro rallied against the dollar. Wayne, these are your own disciplines turning against you. Why are you still defending the Fed?
Well, because you're misreading them, Larry. We've got core commodity prices, and we've got overall commodity prices are still down 27% year over year.
Right.
That doesn't change. So we've got headline inflation numbers reported this morning at 1.1%. I mean, that's a marvelous headline number.
I agree. Let me go to Peter Schiff. Peter Schiff, your thoughts on Wayne Angell's analysis, and more generally, your thoughts on Mr. Bernanke's shock and awe today, Peter.
Well, Wayne couldn't be more wrong in his analysis. I mean, first of all, Ben Bernanke is actually gaining some ground on Alan Greenspan in the race for who can be the worst Fed chairman ever. You know, you're not going to revive the economy by creating inflation. You're going to kill the economy. You know, the fact that commodity prices have come down, that's a temporary factor associated with deleveraging. Consumer prices have come down a bit because you got a lot of going out of business sales. You got a lot of inventory being liquidated. But the inflationary pressures are building, and they're building fast. The dollar is dropping like a stone. By next year, you're going to see commodity prices going through the roof again, consumer prices going up, and this inflation genie is going to be so far out of the bottle, there's going to be no way the Fed can rein it back in.
Hang on, Peter. I got two more voices to get through real fast. Bob McTeer. All right, you heard Peter Schiff, and you heard Wayne Angell. Who was right in your judgment, Mr. McTeer?
Wayne Angell was right.
Why? I thought you wanted the Fed to hold at 1%. That was the report I had. You guys flip-flopped during the course of the day. Why is this?
Let me explain. When I thought that the Fed funds rate would be the only game in town, I didn't see the point. But when they packaged it up with all the rest of that, it became a beautiful package.
What, buying everything that moves? The Fed's going to buy everything that moves, right? Mortgages, consumers, treasury bonds.
Nobody else is.
We used to say if it moves, tax it. If it moves, regulate it. Now you're saying if it moves, the Fed should buy it.
If it moves, buy it. Nobody else is buying.
We can just print prosperity. That's fantastic. Nobody needs to work anymore. Why don't we share this invention with the rest of the world?
Brian Westbury,
all we got to do is print money.
Wide field to discuss here, and we got to have you come back after this. But go ahead, Brian. Weigh in. You've heard Wayne. Right. You've heard Bob McTeer. Right. You've heard Peter Schiff. You've heard Rick Santelli. You've heard Bruce Leisman. You've heard Steve Leisman, and you've also heard Ben Bernanke. Who's right and who's wrong?
Well, I mean, that's a long list. Let me just put it this way, and that is that the real problem we have is not with the borrower. There's plenty of borrowers that want to borrow money. It's with lenders, and it's very, very difficult for people to lend money when interest rates are so low and risks are so high. So I never have figured out how we can cut interest rates and make lenders happier about lending. That's not going to help the economy.
You know, sometimes, Brian Westbury, when I think about this, I lean back and I close my eyes and I just try to meditate and cogitate on what we have: a zero interest rate from the central bank and an unlimited expansion of the balance sheet, which they pledged today to expand even more. It has a certain Latin American feel to it, Brian.
Absolutely.
It does, but, you know, we tried this back in 2003 and 2004 when interest rates were 1%. And if you remember, we were going to hold rates down for a considerable period, and that was all designed to get mortgage rates down. And what we ended up with is a housing bubble. And so I'm not quite sure why we're trying to follow the same policies that got us into the housing bubble in the first place. It doesn't make sense.
We got to get out. Stay right where you are.
We're now officially a banana republic.
Right where you are, please. We got much more work to do. CNBC reports coming right back after this. This is a controversial topic. I don't want to be the Grinch to steal Christmas, but I have my doubts about today's Fed. We're back with Wayne Angel, Bob McTeer, Brian Westbury, Peter Schiff, and waiting in the wings, Steve Leisman and Rick Santelli. Mr. Santelli today gasped on the trading floor as the dollar hemorrhaged against the euro as the Fed came in with its most dramatic pump priming probably since, I don't know when, the middle 1930s. Anyway, Peter, I want to go to you, Peter Schiff. We used to have a saying in the trading room of the big firm I used to work for. I might add that firm is no longer in business. This was many years ago. I used to call it palm trees growing on the trading floor as the Fed was pumping out large quantities of money. And, Peter, I want you to respond to this because I want to ask Wayne Angel and I want to ask Bob McTeer when the last time they went to Argentina, because that subject interests me a lot. Meanwhile, on the full screen, we're going to put the Fed's balance sheet, reserve bank credit, we're going to put the monetary base, and we're going to put M1, just to let people see the degree to which we have expanded the money side. Just throw it up there. Reserve bank credit's over 100%. Monetary base is, I think, even on a smooth basis, about 45%. And M1 and M2 are both growing about 8%. Peter Schiff, where is this going to lead? Where? We're going to get economic recovery?
No.
Are people going to buy mortgages? What happens,
It's going to lead to disaster. No, you're right to bring up Argentina. A lot of people bring up the example of Japan. We're not going to follow in Japan's footsteps. They're a wealthy creditor nation. They have a high savings rate. They had a trade surplus. We're going to follow in the footsteps of Argentina. So if you want to look at America's future, go look at Argentina's past. This is what is going to happen. You know, all we're doing is creating money. Asset bubbles have burst. Real estate prices have to fall. Companies have to fail. This phony service sector economy has to be allowed to unwind. We have to let the free market function. If the government simply tries to manufacture savings out of thin air and get people to go deeper into debt to buy more products that we can't afford, they're going to destroy our currency. Look at that chart of the dollar.
Peter, why do you think that the very distinguished Bob McTeer and the very distinguished Wayne Angel don't agree with you? Where's the disagreement?
Look, they've been wrong for years. You know, they didn't see this train wreck happening. It was right in their face. You know, I've seen this disaster. I wrote a book about the coming economic collapse. So they haven't understood these dynamics.
Let me get a response. Let me get a response. Wayne Angel, please respond to Peter Schiff.
Well, that's just sheer nonsense. The fact of the matter is that we are not in 2002, but we in 2008, moving into 2009, we are in a serious global falling commodity price movement.
No, we're not.
And the Fed, well, we are. And the Fed is taking the action it needs to take.
No, it's not.
And Bernanke will not be a Greenspan who will leave the ease on too long.
How do you know that? Bob McTeer, I want to ask you that. This, in some sense, unwinding from this massive Fed intervention. It's like unwinding from this massive TARP intervention. The American government is now engaged and intervened in the U.S. economy in ways nobody ever dreamed possible. All right, Bob McTeer, you heard Peter. How do you unwind? How does the Fed unwind? How do we unwind from this unprecedented government intervention?
You don't go immediately from money creation to inflation. The money's got to get spent first, and nobody's spending any money. Everybody's slowed down the velocity. Everybody's hoarding. The financial institutions are hoarding money. And the Dallas Fed conducted 2 conferences in Buenos Aires I made a speech on the floor of the Buenos Aires Stock Exchange, and I visited Evita at her grave. So
Did that remind you of the current situation? I'm delighted. I used to spend some time in Buenos Aires, but it was when they were pegging to the U.S. dollar and gold. We're doing neither.
Larry, I think you have to give the Federal Reserve a little bit more credit for thinking about an exit strategy here. Peter, just give me half a second here. I'll be done. There are several programs the Federal Reserve has put in place that basically unwind themselves, and they offer interest rates that are not competitive in a more normal market, but they are competitive and actually advantageous in this very frozen up market. Let me give you another example of the TARP here. The TARP money is a dividend of 5% for 5 years that goes to 9% after the 5th year. So there is an incentive there for a bank to come forward and take out the government in the 5th year. There are several programs here that have embedded exit strategies.
What about the, okay, that's an interesting point, but Brian Westbury, I don't know about those incentives regarding commercial paper. And
5 years is a long time.
These consumer loans, you know, they're going to buy the asset-backed consumer paper and so forth, the mortgage-backed paper. I mean, Brian, I guess the basic question here this evening is, will this work? Will this work? Will this get the American economy growing next year without inflation?
My belief, my sincerest, deep down to the bottom of my heart belief is that mark-to-market accounting is killing us, and that everything the government is doing is to try and offset the damage that mark-to-market accounting is doing. They're injecting capital into financial institutions when mark-to-market accounting is erasing it. They're buying assets, they're pushing money to the Fed, expanding the balance sheet when private sector companies won't hold these assets because they're afraid they're going to get marked down.
But it's not the accounting that's bad, it's the assets.
Peter. And,
I agree with Peter Schiff on this.
So I believe that mark-to-market accounting is killing us, and we're doing all of these things to try and get around it. Now,
that's like blaming your fever on the thermomometer. I mean,
no,
the problem is the assets.
That
yes,
is a lousy. That is a terrible analogy.
No,
it makes no sense whatsoever. None
you
whatsoever.
think these assets are so valuable? You buy them.
Why would I buy them when they're going to get marked down in my face?
Why would you the government intervention, there you go. You just said it. That's it.
Go ahead, say it again.
The fact is that Brian said, why would I buy them when they're going to go lower? Hence, the presence and the footprint and the shadow of the government keeps the vultures in the system for doing what it does best.
But no, that's not true.
I just want to know, gentlemen, this is something that bothers me. I have been a proponent of easier money up to a point. Now, the Federal Reserve, which distinctly, clearly mentioned its own balance sheet, that's how they're going to operate. It's sort of a Milton Friedman-like policy, expand the balance sheet, pump in a lot of new cash. Look, gentlemen, Wayne Angel, you first. I want to get a whip around. The Fed has expanded the balance sheet from $900 billion to $2.2 trillion. They've done that in a couple of months. They may go to $3.5 trillion. When is enough, Wayne Angel? When is enough? Because I don't want Rick Santelli, who I dearly love, tomorrow to go down for the count if the dollar loses again against the euro. I may lose the guy. And this program and this network cannot afford to lose Santelli.
The United States can't afford it.
The country cannot afford to lose Santelli if the dollar crashes again against the euro. Wayne Angel, help me out. How much do they have to expand their balance sheet?
We have never seen the kind of excess reserves in the system the Fed has in today. But I just guarantee you that Chairman Bernanke is going to pull those back as soon as he sees the first signs of rising prices.
Real quick,
Larry.
Whip around. Peter Schiff, real quick, and then Brian, and then Bob McTeer. Real quick, whip around, fellas. I'm out of time.
Yeah, the idea that they're going to be able to raise rates when they finally see inflation is nonsense. If they won't raise them now, they'll never raise them. The longer they wait, the harder it's going to get. They're just going to keep lying
Brian
about it.
Westbury, did Ben Bernanke sign on to Team Obama today? Basically, is that what we saw?
Basically he did. But one thing to remember about this expansion in the balance sheet, it is not all printing money. In some cases, they borrowed money from the Treasury and bought assets. That just expands the balance sheet. It's not printing money.
Bob?
And when they take reserves from banks and buy commercial paper, that's not printing money either.
Bob McTeer, I need you to tell me, how are we going to unwind this unprecedented government intervention by the Fed?
First, let me say that Brian's absolutely right about mark-to-market. And secondly, you keep priming the pump until some water starts coming out.
And what happens?
And then the ship sinks.
Yeah, that's, ooh, we may have to end on that note.
Look, the economy is falling off a cliff.
Rick Santelli, I want you to
we don't
give me
need
the
the
last
Fed
word.
to push it.
I want to make sure Rick Santelli is still operating because, as I said before, the country cannot do without him. But I worry if the dollar cracks up again against the euro. Rick, you get the last word.
Well, I think that the dollar is going to have a heck of a time, and I think as good as that may be for exports, the real notion of a falling dollar and why it's good for exports is because the average American can't afford to buy what the rest of the world's selling at the same price due to its currency, and I think that's key. And remember, all of this stimulus,
The producers
you can't eat an iPod, and I want to say that.
Rick drinks way too much French wine. It's not an issue. If you're not drinking French wine, domestic purchasing power of the dollar is stronger given declining inflation.
Wayne
Not
Angel,
for long.
Go to California
Wayne
Wines,
Angel,
Rick. You'll be in
Bob
good shape.
McTeer, Brian Westbury, Steve Leisman, Rick Santelli, Peter Schiff. You're going to serve a little more time in the stock market group. Thank you very much. Meanwhile, President-elect Obama weighed in on the Fed today, and I actually approve of what Obama said. We have our chief Washington man, John Harwood, here. All right, joining us now on the stock side, we have Dennis Gartman, editor and publisher of the Gartman Letter. We have Ken Hebner again. We have Peter Schiff again, are still with us. We lost one casualty down in Fort Worth. Maybe we'll get LeCamp back or not. Dennis Gartman, God, I love reading your newsletter every single morning. Let's do a quick whip around. Does the Fed action today, Dennis, guarantee, as much as anything can be guaranteed, that November 20 was the bottom in stocks?
I think it does, Larry. I think they've done exactly what they needed to do. I understand the concerns that they may be a bit overstimulative. I know that Peter Schiff is not going to like that comment, but yes, I think they've put a bottom into the market, and I think they've guaranteed that the October and the November lows are now finite and will not be taken out.
All right, Peter Schiff, it's the one thing I didn't ask you in the Fed segment. Is there a stock market bottom now?
I doubt it. But even if there is a nominal new low here, there is not a real new low. If you price the Dow in gold, if you look at where it is right now, the Dow is barely worth 10 ounces of gold. We're right on the lows for the move. My guess is by next year, the Dow is going to trade down to only 7 ounces of gold, maybe even 5 ounces of gold. That would be a 50% decline in the real value of U.S. stocks priced in gold. Who cares what happens priced in dollars? Because we're putting those into oblivion.
All right,
I live in dollars.
And
not for long.
Let me get my friend Ken Hebner. Ken, again, this is a whip around. We're going to come back. You mentioned in the earlier segment when we soloed you, you like financials and insurance. Ken, just real quick, the second-rated group today, which did very well, was basic materials, commodities, and the third was consumer discretionary retailers. A quick comment. Basic materials, Ken.
Okay, I think that the global recession is going to take us to levels where we have a surplus of commodities for several years. Commodity stocks, including oil, are not attractive.
And retailers. How about retailers? If you're right on commodities, Ken, let's assume commodities keep falling. We've seen a tremendous retail gasoline drop, which is very bullish for consumers. Would you buy retailers and consumer discretionary?
Well, I think a year from now, the consumer is going to be growing. Consumer spending will be rising in the year 2010. It could even happen before that.
All right.
So there will be opportunities in retailers.
It's all going to be for food and energy, though.
All right, hang on. We're going to come back. I got to jump. We're going to come right back. Please stay where you are. I want to walk through some of these key groups. I want to walk through some of the logic. And I want to ask, by the way, does anyone want to cut tax rates? This is all demand-side stimulus, big government stuff. That doesn't produce productivity or growth or investment. CNBC reports coming right back. I'm Larry Kudlow. Straight ahead. All right, we are back. Dennis Gartman, Ken Hebner, and Peter Schiff. Dennis, I want to go back to a mustard seed here with the plunge in gasoline prices. You see it in today's consumer price index. This is the third straight decline, minus 10% last 3 months. And it's only rising at 1% for the past 12 months. Now, Dennis, here's the gig. We're going to put it up on the screen. This is a big tax cut for consumers. It's a mustard seed. Real average weekly earnings are now beginning to rise. They're up over 2% in November. If I use the Labor Department's unemployment, the average hourly earnings, those were growing at 3.7% nominal. If you take 1% off for the CPI, suddenly they're up about 2.7%. Now, could this have been one of the reasons why we saw a little better core retail sales? And maybe people are just too darn pessimistic because they're not listening to my mustard seeds.
Well, I think this is a very good point that you make. I mean, this is really a huge tax cut for the American public. And what you also have to take into consideration, Larry, I find it fascinating that as gasoline prices have fallen by 75%, if you look last month, usage of gasoline, which you would expect to have gone up, is still down another 5% on top of it. It is as if the American public has said, you know what? I saw $4 gasoline. I've learned how to do with less. I am, in fact, using less. I think that's really important. So you have a double whammy. You've got an increase in income. You have a decrease in the cost. And you have people actually using less. The savings rate in the United States is about to go skyrocketing.
Well, I guess when you have no job, you don't use that much gas because you don't have to go back and forth to work anymore.
Well, Peter, that's not what's happened. I mean, unemployment is obviously rising, but it is not anywhere near what we saw in 1973 and 74, and it's not anywhere near what we saw in the 1930s. So come on now.
I think you're seeing a decline in the standard of living, and that's why people are consuming less.
But Peter Schiff, can I sell you a couple of mustard seeds that may grow into recovery trees, if only cyclically? I mean, the consumer price index coming down. It is following the retail gasoline and the energy. But you know what? It's across the board. I mean, the core CPI, take out food and energy, the core CPI has come down. At least on a cyclical basis, Peter, this is the kind of thing that the pessimists won't look at. It could promote a much stronger 2009, and the stock market will discount that ahead of time.
Not a chance, Larry. You know, I don't give a lot of weight to these government measures that purport to measure the effects of inflation, you know, in prices. They're all meaningless, I think. I think we've got to really look at what the Fed is doing with his balance sheet, with money supply, watch the exchange rate of the dollar, watch the price of gold. You want to know what's going on with inflation, don't look at these government numbers. And as I said, I do acknowledge that there have been some falling prices recently. This is temporary. And again, prices rise and fall as a result of inflation. So to see prices coming down and think, oh, there's no inflation. No, there's plenty of inflation. The forces are just being held at bay right now because other factors are stronger. But these are temporary factors.
On the way out, Ken Hebner, do you fear inflation, and what do you think about the possibility that the energy and retail gas tax cut could give us a more promising profits picture as well as a consumer picture?
For the next several years, there's not going to be an inflation problem. We are rapidly bringing the global economy to a level where there's a surplus globally of labor and raw materials, which no matter how much growth we have in 2010 and 2011, the pricing level globally is going to be in a downtrend.
And so that is the reason why you are staying away from the basic materials. Is that fair,
right,
Ken?
That's right. However, I want to point out, between 1870 and 1900, we had great glable growth and a declining price level. Let's not get deflation and growth confused.
That's because we had sound money back then. We were at a gold standard.
Hang on. We're going to come back, gentlemen. Please stay where we are. We have more work to do, and I want to talk about some of the sectors that rallied today on the Bernanke announcement. Coming up, it looks like SEC Chairman Christopher Cox has awakened from his deep sleep. He may have been listening to our own Charlie Gasparino, as we all must. Charlie has the latest on the Madoff scandal when CNBC Reports continues. Stay with us. Christopher Cox, back from the dead. I'm Larry Kudlow. We'll be back after this. All right, back with Dennis Gartman, Ken Hebner, and Peter Schiff. Ken Hebner, you've been so good to us this evening. I appreciate it. I want to ask you about another big story, and that is getting mortgage rates down. The Federal Reserve very strongly suggested today they were going to go out and buy not only conventional Fannie Freddie type mortgages, but probably mortgage-backed securities in general, including the toxic ones. They want mortgage rates down. There's another big story out, Ken, that the Obama people are going to spend trillions of dollars to buy mortgages themselves. That from economist Kevin Hassett, who knows a thing or two. Would you buy home builders, Ken Hebner? Do you believe that the Treasury and the Fed can get mortgage rates down? Is it time to revisit home builders, which have been so decimated?
Okay, complicated question. The historic relationship between a 30-year Treasury, between Treasury bonds and mortgages is for them to sell at 125 to 150 basis points above. So with a 30-year Treasury at 3%, you can see mortgage rates at 4.25, 4.5. So they're setting the stage with this Treasury rally to getting mortgage rates down there. The question on home builders is more complex. I suspect that they will outperform the market over the next several years, starting now, and they've been outperforming for the last 6 months. But with the vacancy rate as high as it is,
but would you buy home builders?
I don't. It's a tough call. I do not own them now. I might. They're outperformers, but whether they're the most...
Can I get some quickies? I'm sorry, we're running out of time.
It's an easy call from my perspective. No, don't buy them.
Right. Peter, this artificial getting rates down, do you buy into it?
No, it's not. We need lower home prices, not lower mortgage rates. That's the answer to affordability. And we have too many homes. We need to stop building homes. We built too many. That's the problem. We overbuilt.
Stop building homes, Peter.
Yes.
And Dennis Gartman, let me give you the last word.
No, they're still constructing.
We're running out of time. Dennis, do you buy the lower mortgage rate story, and where would you invest on that basis?
Yes, I buy the lower mortgage rate story. And where would I invest? I think Mr. Huebner was correct. You want to own banks. It's a positive slope to the yield curve. And I think you want to own infrastructure, steel, the things that if you drop them on your foot will hurt.
All right, we're going to leave it there. Gentlemen, very helpful. I appreciate it very much. The post-Bernanke stock market strategy, Ken Huebner, Dennis Gartman, Peter Schiff. We'll be right back after this.